Today, we're going to pull back the curtain on a financial instrument so powerful it literally reshaped modern finance and, yeah, played a starring role in the 2008 crisis, the synthetic collateralized debt obligation, or synthetic CDO for short.
So let's start with a question, because this really gets to the very heart of what makes these things so powerful and so controversial. The answer to this unlocked a totally new way to package, sell, and shuffle risk across the entire global financial system.
To get that answer, you have to understand what's going on under the hood. You can almost think of it as a synthetic machine. It's a process built not on physical stuff, but on something much more abstract, pure risk.
Okay, so here's the absolute key to wrapping your head around this. A synthetic CDO, it doesn't actually own a single loan or bond. Not one. Instead, it uses these fancy financial derivatives to, well, mimic the risk of those loans. You're not buying the debt itself, you're basically placing a bet on whether that debt is going to get paid back.
And when you put them side by side, the difference is, well, it's pretty stark. A traditional, regular old cash CDO is like owning a crate of apples. You have the actual fruit. But a synthetic CDO? That's more like a collection of bets on whether those apples will ripen or just rot on the vine. You get all the financial exposure without ever having to touch a single apple.
So how is this synthetic machine actually put together? Where does it all start? Well, it all kicks off with one fundamental component, a powerful, but actually surprisingly simple piece of financial engineering. Let's talk about the credit default swap, the CDS. Honestly, the easiest way to think about it is just as an insurance policy on a loan. It's that simple. A buyer pays a regular fee, like a premium, to a seller. In return, the seller promises to cover the losses if that specific loan defaults. This simple contract is the core building block for the whole shebang. Building one of these things is really a three-step process, super systematic. First, you create these little CDS insurance policies on hundreds, sometimes thousands of different loans. Step 2, you bundle them all up into one giant portfolio. And then for step 3, you slice up the combined risk of that entire portfolio into different pieces, all ready to be sold off to investors.
And that slicing process, that's called tranching. Imagine a tower, okay? The bottom floor, that's the equity tranche. It's the riskiest. It takes the hit on the very first default. Then you've got the middle floors, the mezzanine tranches, which are a bit safer. And way up at the top, you've got the penthouse, the senior tranche. It's supposed to be the safest of all, only taking a loss after all the lower levels have been completely wiped out. And that is how you can take the same pool of risk and sell it as both a super risky bet and a supposedly rock-solid investment.
Okay, so we've got the mechanics down, but honestly, to understand the true market-shaking power of this thing, you have to look at its history. I mean, its rise from just some niche financial product to the absolute center of the global economy, well, it happened astonishingly fast. Believe it or not, it all kicked off back in 1997. JP Morgan cooked up the very first synthetic CDO as really a pretty clever way for the bank to manage risk on its own books. But it didn't stay that way for long. Pretty soon, the market shifted from these internal bank tools to what they called arbitrage deals, designed purely for investors. And that's when the market just exploded, all culminating, of course, in its infamous role in the 2008 financial crisis. And when I say the market exploded, I mean it. The scale was just staggering. Get this, by 2008, the value of the CDS contracts that were powering these things, it had ballooned to over $2 trillion. That's a T. And this chart right here, it just gives you a perfect visual of that insane growth. Look at the beginning of 2002. You're talking about maybe $10 billion of these things being created each month. Fast forward just 2 years, and that number is peaking at over $80 billion a month. The financial world was absolutely hungry for this stuff. But you know, even as this whole thing was booming, there were warning signs. People were sounding the alarm. This quote here really nails a critical flaw. People were putting blind faith in these incredibly complex computer models used to price the instruments, and they were doing it without really understanding the huge risks that were baked right into them. So what happened? Well, this over-reliance on the models, you combine that with a ton of leverage, and what you get is a systemic risk that just spreads silently through the entire system. So when the underlying assets, we're talking especially about subprime mortgages, when they started to fail, the losses just cascaded through these interconnected synthetic instruments. It was like a domino effect that helped trigger a global meltdown. Now, after a history like that, you'd be forgiven for thinking these things just vanished, right? But they didn't. Nope, they evolved. So what role do they actually play in today's market?
Well, here's the thing. When they're used the right way, they're still an incredibly efficient tool. I mean, they let banks and funds manage their risk without the hassle and cost of selling the actual loans. They give investors a backdoor into markets they couldn't otherwise touch. And they let you create these highly tailored, super specific risk profiles, often for a lot cheaper. But, and this is a huge but, the very same risks that blew everything up back then, they're still there. These things are still incredibly complex and opaque. They use a ton of leverage, which means even small market moves can create massive losses. And at the end of the day, everything hinges on the pricing models being right and on the person on the other side of your bet actually being able to pay you when the time comes.
So, what's the big takeaway here? It's this. Synthetic CDOs aren't inherently good or evil. They're just powerful, highly specialized tools. They're like a double-edged sword. In the right expert hands, they can offer incredible efficiency. But without a deep understanding of the risks involved, they just become massive amplifiers of financial danger.
And that really leaves us with the big question, doesn't it? Are instruments like this a necessary form of financial innovation, something that helps markets work better? Or do they always pose a systemic danger that we just can't afford to get wrong? You know, the debate on that, it's still going strong.
This is not financial advice.